Yeah.
Just like any other clock, the property clock cycles around in a fairly predictable fashion, so that you can see how when people talk about timing the market, this is what they mean, market fluctuations. What's the general progression of those fluctuations? So we start at the peak, which is 12 o'clock. That's the boom market. Prices are at their highest. The market's peaked, FOMO's peaking, so peak prices, boom. So when the boom cools off, the fear of missing out is replaced with a fear of overpaying. So buyers hesitate. They realize that the market's overcooked. They don't want to overpay, so they pull back. And we have what's called the start of the decline. So that's 1, 2 o'clock into 3 o'clock, declining market. So prices pull back. What tends to happen is properties sit on the market longer than usual because vendors still want their top dollar. They've just missed the peak, but they're still chasing that top dollar. So the market declines. Because the longer a property is on the market, the more fatigued the vendor gets, the more purchasing power the buyer has, or more bargaining power the buyer has. So you start to get this decline, nearing the bottom, down to the bottom of the market. So that's where we find a floor. Basically, the floor or the bottom is the lowest price a vendor will take for their property before they decide to just hold on to it. Once we find the floor, that equilibrium, once we find the floor, then and only then does the market start to recover. So from 6 till 9 is your recovery, and then from there it picks up momentum, because once people see that recovery, all those vendors that were waiting it out, buyers start to get a little bit anxious. Oh, the market's moving, my savings aren't going to keep up, I better buy. So buyers start to get it, and then that momentum zooms us around back up to the peak, to another boom.